You're at the dealership, you've picked out the car, and then the process stops. The finance manager returns with a rejection notice, and you're left sitting in the parking lot with nothing. Lenders rely on automated risk filters that trigger an immediate rejection when your score falls below a specific threshold. This automated lockout extends to almost every corner of the economy. It leads to rejected apartment applications, denied car loans, and flags on employment background checks. The American credit system uses this single metric as the primary gatekeeper for societal participation. Falling below the required number prevents access to basic financial tools. A low credit score functions as a digital barrier, effectively isolating an individual from the modern economy. Even when an application is approved, a low score carries a heavy, long-term financial penalty. Banks categorize scores in the 500s as high risk, applying higher interest rates that double the asset's cost. This multiplier forces lower score borrowers to pay tens of thousands of dollars more over their lifetime for the exact same goods. The credit system is mathematically structured to keep high-risk individuals in a cycle of expensive, recurring debt. Credit assessment takes place within high-density server racks. It is a process of cold, data-driven risk management. A credit score is a mathematical algorithm. It processes specific data inputs to generate a probability of default. Because the system relies on predictable logic, the outputs can be changed by modifying the data that the algorithm receives. Raising a score is a matter of identifying and adjusting the variables that the scoring model is programmed to prioritize. The most volatile variable in the algorithm is credit utilization. This is the ratio of current credit card balances relative to the total available credit limits. When balances hit 90% of the limit, the software triggers a high-risk alert, causing an immediate score drop. Increasing the credit limit stretches the account's capacity, diluting the percentage and moving the needle back to low risk without paying down the balance. Adjusting this ratio forces the algorithm to recategorize the borrower as financially stable. The second strategy involves challenging negative marks on a credit report, such as late payments or accounts in collection. Federal law requires credit bureaus to verify the accuracy of any disputed item. If the bureau cannot provide independent verification within 30 days, the item must be deleted. Formal dispute letters initiate this 30-day timer. If the bank's verification department fails to respond before the clock hits 0, the derogatory data is removed from the profile. This process uses the administrative requirements of the banking system to clear negative data and facilitate score recovery. The final method for rapid score improvement is authorized user status, commonly known as piggybacking. This involves adding a damaged profile to an existing, long-standing credit account held by a family member with a perfect payment history. The algorithm treats the authorized user as sharing the primary holder's entire history. Years of positive data are instantly added to the damaged profile, overriding the impact of previous credit issues. This allows a borrower to adopt the established history of a prime account holder, immediately changing how the system perceives their risk level. When these precise data points are fully updated at the credit bureaus, the scoring algorithm automatically recalculates your entire risk profile. Rejections are replaced by approvals. Housing applications and loan requests that were previously blocked now move through the system without friction. Accessing prime interest rates stops the drain of the poor tax, allowing for significant wealth retention over time. The American credit system operates on rigid, predictable regulations. Navigating these specific requirements allows for consistent, favorable financial outcomes. A credit score is simply a direct reflection of your data inputs. Understanding how to manage those inputs provides the means to define your own financial standing.